Hello and thank you for joining me today. My name is Kevin Reno and I'm the Regional Public Affairs Specialist with the Social Security Administration. Today I'll be presenting to you a high-level view of Social Security, how you can go about getting a benefit, what types of benefits we offer, when you should consider applying for a benefit. We'll touch upon the windfall elimination provision and the government pension offset, and then wrap everything up with a discussion on Medicare. So hopping right into it. So Social Security was signed into law in 1935, and at that time, its primary mission was to provide low-income, aged individuals with just enough money to stay above the federal poverty level. Now, if you fast forward to today, that is still our primary mission. What we have found is that on average, Social Security is going to replace about 40% of your pre-retirement income. Now, let's be very clear. Social Security, when it was signed into law and through the ages, it was never meant to replace in its entirety your pre-retirement income. So when we have these presentations, one thing we always like to stress is Social Security is a base, and it is a foundation for a healthy retirement portfolio because every month that check will be issued. However, you're going to need things like pensions, savings, and investments to help you continue to maintain your standard of living into retirement. The reason for that is what we have found is that most people need to be able to replace about 70% of their pre-retirement income to kind of transition comfortably into retirement. And remember, on average, we're only going to give you about 40%. So how do you go about getting Social Security? Well, you do that by earning credits when you work and pay into the system. So taxes, specifically FICA or SECA taxes, the Federal Insurance Contribution Act or the Self-Employment Contribution Act. Now, to become vested into Social Security, you need to contribute 40 credits. And that works out to roughly 10 years worth of work, and you must be at minimum 62 years of age. Now, this number changes year to year, but the value of a credit for 2022 to earn one credit is $1,510, and you can earn up to 4 credits in a year, meaning that if in 2022 you contribute $6,040 through either FICA or SECA, you will have your 4 credits for this year. So once you get your 40 credits, the next most common question we get at Social Security is, well, when can I retire? And really the answer to that varies. It all depends on the individual. So when we're looking at retirement, you're looking at a window of time. And one of the most important dates within that window is your full retirement age. Full retirement age is when we're going to give you 100% of what it is you are due based on what you have contributed to the system. Now, from 1937, when we issued our first check, all the way to 1982, full retirement age was a very easy number to tack down, very easy age to tack down. It was 65. And, and today that is the number the age most people associate with retirement, 65. However, in 1983, the Social Security Amendments Act was passed, and this changed a whole lot about how Social Security works. And one of the things it did change was an individual's full retirement. And what they did is they said, based on when a person was born, their full retirement age might be a little further out than 65. So for individuals born in 1937 or before, their full retirement age is 65. People born in 1938, well, their full retirement age is 65 and 2 months, 39, 65 and 4 months. And it continues to go up until you encounter individuals born after 1960. If you were born after 1960, your full retirement age, the age in which we can give you 100% of what it is you are due from Social Security, is 67. So let's take a look at an example of your retirement window. So you remember a moment ago I said the earliest that you could retire was age 62. So anything before your full retirement age, whatever that age may be for you, is considered early retirement. So if in this example here, we have an individual whose full retirement age is 66. So at 66, they get 100% of what they're owed. And for this example, that's $1,000. Now, that individual does not need to wait until 66. They can apply in that early retirement phase, which is as early as age 62. But if you do that, the benefit is reduced. And if you're looking at this graph here, you can see for someone whose full retirement age is 66, they would be looking at about a 25% reduction on their benefit. So instead of getting $1,000 at 66, if they went out at the earliest possible age that they could, 62, they'd get a benefit around $750. Now, for every month you wait, for every year you wait, you get closer to that full retirement age value, the benefit goes up. So if this person said, okay, I'll wait until 63, well, now they're looking at a benefit of $800. 64, $866. Every month you get closer to your full retirement age, the value of the benefit goes up. If you wait until beyond full retirement age, you then enter what are called delayed retirement credits. And what delayed retirement credits are is for every year you go beyond your full retirement age up until age 70, we will boost your benefit by roughly 8%. So if your full retirement age again was 66 and you waited until 67, your benefit would be 1080. If you waited until 69, 1160. And it keeps going up and up by 8% until 70. Now at 70, there is no more increase in the benefit due to just waiting. So when you're thinking about your retirement window, what you're really thinking about is a window that starts at 62 and for the purposes of maximizing the benefit ends at 70. Now, at no point in time in that window are you mandated to enroll, nor are you mandated to enroll after 70. But there's no benefit in waiting beyond 70. Returning for a moment to early retirement, one of the things that is very important to note about early retirement is, besides the fact that the benefit is reduced, if you are working, work in early retirement can impact benefits. So let's take a quick look at how that would work. So again, these are a set of numbers that change annually. So if you are a few years out from, say, early retirement, this would be something you would want to check. These numbers, like I said, change year to year. For 2022, if you have an individual who is in early retirement, that age before full retirement age, the maximum they can earn before their benefit would be reduced is $19,560. Now, what will happen is if an individual goes over that, in the next year, we will reduce their benefit $1 for every $2 they went over $19,560. Meaning if the individual went over that by about $10,000, they would owe us back $5,000. And how that works is we would just keep the checks, we would redirect the checks back to the Treasury Department until we have recouped our $5,000. And then once we have our money back, we would pay out whatever benefit is due. Now, if you are in the year in which you're going to reach your full retirement age, the math is a little different. In that instance there, the most you can earn before we're going to reduce your benefit is $51,960. In this scenario, if you exceed that value, in the next year, we're going to reduce your check $1 for every $3 you go over. Last but not least, if you are at or beyond full retirement age, there is no limit on how much you can earn. It has no impact, no negative impact on your benefit. Now, it could increase your benefit because we're always looking at your earnings. We'll always do a recalculation of your benefit based on earnings, even if you have retired. And we'll touch upon how we calculate a benefit in a little bit, but work after retirement can actually increase the benefit because you're still contributing into the system. But as far as a negative repercussion at or beyond full retirement age, there are none. So we've gone over quite a bit right now, a lot of general information about retirement benefits. If you want to know more about your retirement, how much you're eligible for, how many credits you have, if you wanted a breakdown of the month-to-month value of benefit, I would point you in the direction of our amazing website, socialsecurity.gov, ssa.gov. There are a number of resources on that page, but the two most important that I can think of right offhand are establishing what's called a My Social Security account. This is an application. It's a one-stop shop for you regarding all of your Social Security information. It informs you what your full retirement age is, what your benefit would be at 62, full retirement age, and 70. It provides you with your earnings record. Your earnings record is what we use to determine your benefit. We'll touch upon that in just a moment. It tells you what you could get if you were eligible for disability, what your spouse can get for a benefit, if you were to pass away, what your survivors could get. It's an amazing resource, an amazing tool to review if you're in that planning phase for retirement. Now, the other thing that our site has is our retirement estimator. This estimator, giving it just a little bit of your personal information, allows you to pick a date within that 62 to 70 window, any month and year within that window, and it'll project a benefit based on your earnings record. So if you wanted to know the difference between your benefit at 62 and 3 months, 64 and 5 months, and 68, the retirement estimator could tell you what those are. It's an invaluable tool in assisting in that pre-planning to figure out what type of benefit you would get. So again, the website is socialsecurity.gov or ssa.gov, and I would highly recommend reviewing it and setting up your own My Social Security account so you can see your benefits. So now that we kind of understand how you can go about getting Social Security benefits, let's talk about some of the benefits that we offer. So again, what we just discussed is essentially retirement benefits. Retirement benefits, as I said, came out in 1935, and at that time they were just for the worker. The worker would work, they would stop working, and they would get retirement. And when you think about the American household in the early 30s, late 30s, early 40s, they were predominantly single income households. And what they found was retirement worked great until that worker passed away. And if their spouse had never worked, any form of income that the household had disappeared, and then that household was plunged into poverty. So in the late 30s, early 40s, spousal benefits were introduced to Social Security. How spousal benefits work are, in their simplest form, we take that primary wage earner's benefit, we cut it in half, and that's what the spouse can get. So if the primary wage earner is eligible for a benefit of $2,000, their spouse is eligible for a benefit of $1,000. Just like your own benefit, you can take a spousal benefit as early as age 62. But if you do, just like your own, it is reduced for however far you, the spouse, are away from your full retirement age. Spousal benefits do not impact the primary wage earner's benefit at all. So again, if that primary wage earner is eligible for $2,000, their spouse is eligible for $1,000, that has no impact whatsoever on the $2,000 that the primary wage earner gets. If you fast forward to the present, a lot has changed since the late 30s, early 40s. And when you're looking at or thinking about spousal benefits, one of the major changes that has occurred is that most households now in the United States are dual income households. So what happens when you have two individuals who are potentially eligible for Social Security? Well, the math gets a little more complex. What we're going to do, where we're going to start, is that primary wage earner's benefit, and we're going to cut that in half. We're then going to look at the secondary spouse's benefit, and we're going to determine if that benefit is more or less than one half the primary wage earner's benefit. Now, if that benefit is less, what we do is we take that benefit, we pay it to the individual, and then we say, okay, let's say again, the primary wage earner's benefit is $2,000, so half is $1,000, and the spouse is eligible for $800 on their own record. We would pay that spouse their $800 and then give them an additional $200. The difference between their own benefit and one half their spouse's brings them up to the value of one half of the spousal benefits, and that's what we'd pay. Now, if the spouse's benefit is greater than one half of the primary wage earner's benefit, then in that instance there, the spouse gets nothing. Well, pardon me, they get their own benefit, but they would not be eligible for a spousal benefit. So to kind of simplify, for dual income households where both individuals are eligible for Social Security, the spouse trying to collect the spousal benefit must have a benefit that is less than one half the primary wage earner's benefit. And if their benefit is less than one half, they get their own benefit plus the difference between their own benefit and one half the spouse's. Moving on, we also offer divorced spousal benefits. The math here is exactly the same. For a divorced spouse, the individual has to be unmarried. They have to be at minimum 62 years of age. Now, one key difference between spousal benefits and divorced spousal benefits, for spousal benefits, that primary wage earner has to collect a check. They have to be getting something. We cut that in half and we give it to their spouse. For divorced spousal benefits, the primary wage earner does not need to be collecting a benefit. They only have to be entitled to a benefit, meaning they only have to have their 40 credits in the system. And as long as they do, their divorced spouse can collect from their record. Just like spousal benefits, it has zero impact on the primary wage earner's benefit. Okay, there is a very specific rule to qualify for divorced spousal benefits, and that is you have to have been married to the individual for 10 years at minimum and divorced for 2. Married for 10, divorced for 2. We also offer benefits for survivors. Survivors' benefits are structured very similar to spousal and divorced spousal benefits, but with a few key differences. The first, when the primary wage earner is alive, the spouse is eligible for one half their benefit. When the primary wage earner passes away, their spouse then becomes eligible for 100% of the deceased's benefit. So using the example we used a few moments ago, if the primary wage earner's benefit is $2,000, now while they're alive, their spouse is eligible for $1,000. Upon their passing, the spouse is now eligible for $2,000. Same rules apply. If the spouse's benefit is less than 100% of the deceased, they get their own benefit plus the difference between their own and 100% of their deceased spouse. If the spouse's benefit is greater than the primary wage earner who has passed away, then the spouse does not get a survivor's benefit. Survivor's benefits can be collected as early as age 60. If you collect a benefit at 60, it will be reduced. Any benefit taken early is reduced for age. If you are disabled, you can collect a spousal benefit in your 50s. In this one instance, it would not be reduced. Disability-related benefits are not considered the same as retirement-related benefits. You can, and this is the only instance in which you can do this anymore, but you can collect just your survivor's benefit while leaving your own benefit alone. So you could come in at, say, 62, file for your widow's benefit, but not have to take your own. For all other forms of benefits, there is a provision in the law that came out in 2015 called Deem Filing, which mandates if you come in and try to file for your spousal or divorced spousal benefit, you must first apply for your own before you can touch it. And the only exception to that is if you were born before 1954. The only instance in which that provision does not apply is for survivor's benefits. For survivor's benefits, like I said, you can take the survivors and leave your own to build value as time progresses. The last type of benefit we offer are auxiliary benefits, benefits for children. For us, a child is considered anyone who is unmarried and under the age of 18. If that child has a parent who is getting either retirement or Social Security disability insurance, they can collect a benefit from their parent. Once that child turns 18, they will come off of that benefit unless one of two things are true. The first is that child is a full-time student in high school. And in that case there, they can remain on the benefit after 18 until they turn 19 or graduate, whichever of the two comes first. The other way a child can potentially stay on their parents' benefits is if we can prove that they had a disability prior to the age of 22. And if we can prove that, they will get what are called disabled adult children's benefits and can continue to get the benefit potentially for forever. If you find yourself in that situation where you may have a child who meets those criteria, you would want to reach out to your local office to file for the disability application and see if they can continue getting that benefit post-18. So now we're going to talk about how we determine a benefit. So it all comes back to the earnings record that I mentioned a few moments ago. The earnings record is a collection of what you have contributed to Social Security through your taxes over the course of your working life. And it's what we use to determine your benefit. And again, you can review your earnings record on our website, socialsecurity.gov. And I would recommend once or twice a year, you do get over there and just take a look at it to make sure that everything is up to date and correct. Because again, it's what we're going to use to figure out your benefit. What we then do, so we take a look at your earnings record, we add up the highest 35 years. We divide that by 420, which is the number of months in 35 years. And this produces your averaged index monthly earnings amount. Basically, the average of how much you earned over the course of your working life per month. Okay, so let's look at an example of what that would kind of look like. So here we have an individual who over the course of their working life earned about $7,000 per month on average. Now that individual would walk away with a Social Security benefit check of $26.93. Now you remember when I started out, I said, Social Security only replaces about 40% of your pre-retirement income. And this is where you see it. If all this individual had going into retirement was Social Security, they would go from earning about $7,000 a month to $26.93. And that's a pretty big hit if you don't want to make any changes to the lifestyle that you're leading, which is why we stress it is extremely important that you have savings, investments, pensions, and other forms of income to help you bridge that gap between our $26.93 and $7,000. And again, that $26.93 number can vary. It all depends on how much you have personally contributed into the system. So how do we go from $7,000 to $26.93? We use three mini equations called the Venn points. And essentially what it is we take that $7,000 and we dissect it. We take the first $1,024 of that $7,000 and we multiply it times 90%. We take the next $10,024 through $6,172 and we multiply that times 32%. We take whatever is left of that $7,000 and we multiply that times 15%. We then add that up and that gets us a benefit of $26.93. We're now going to talk about the windfall elimination provision. Now, the windfall elimination provision impacts individuals who have what are called non-covered pensions. And non-covered pensions usually tend to fall in fields where, in the state of Massachusetts, like teachers, firefighters, policemen, where you're not contributing into Social Security as you work. Windfall elimination provision is the byproduct of the 83 Amendments Act. Prior to that, it didn't necessarily impact an individual's ability to get a Social Security benefit. So really, all the windfall does is it changes the first equation. So instead of multiplying 1024 times 90%, we're now multiplying 1024 times 40%. Now I'd like to pause here to just kind of point one thing out. There's a lot of confusion when it comes to the windfall elimination provision. One thing I'd like to make very, very clear is that legislatively, the windfall elimination provision can never, ever, ever reduce an individual's benefit to zero. It is not allowed under the law. It can reduce it drastically, but never to zero. So what you see here is an individual who would turn 62 this year in 2022 could be hit with a maximum windfall of about $512. Now let's say that the individual's benefit is less than $512. Again, we cannot by law reduce the benefit to nothing. So what we traditionally do with the math, how the math works out, is we will take that benefit and cut it in half if it's less than the maximum windfall. So let's say you had an individual who should be hit with a 512 with windfall reduction, but their Social Security benefit is only $300. Now in that instance there, we would just basically cut their benefit down to around $150. Now what can and oftentimes does end up happening is another provision of the law states that we must take the Medicare Part B premium directly out of an individual's Social Security retirement check. So let's take the scenario here where we had this individual who's getting $300 from us. We apply the WEP, the windfall, their benefit goes down to $150. Now remember, by law, I have to take the Part B premium out of their check too. Now the Part B premium for this year is $170. So roughly $20 more than the benefit we're offering. What happens in those scenarios is that $150 gets applied towards the Medicare premium, making it appear as if the windfall reduced the benefit to zero. It in fact did not. It was a combination of the windfall and the Medicare. And that individual would end up getting a bill at the end of the year for the difference owed on Medicare premiums. So for those individuals, you end up paying less annually on Medicare because, again, whatever you get in a Social Security benefit is being applied against the premium. So again, just to be very, very clear, windfall can never reduce a benefit to zero, but in some instances, the combination of windfall and Medicare can. Second point I like to make about windfall, we only apply it when you're getting both your Social Security benefit and your non-covered pension at the same time. So if you are not getting your non-covered pension, but you are getting your Social Security, you will not be windfalled. But the moment that you begin getting both your Social Security and your non-covered pension at the exact same time, we will then apply the windfall and your benefit will be reduced. Now, there is an exception to windfall. There is a way to kind of mitigate the reduction of benefits. And this is going to occur for individuals who have kind of worked both in the private sector, paying into Social Security, and the public sector over the course of their working life. And these are called years of substantial earnings. Don't get these confused with credits. They are different. But essentially what ends up happening is for every year, we set a dollar value for that year. So I think for this year, it's like $22,000. If you earned over $22,000 in this year, you have 1 year of substantial earnings. And what we're looking at is, well, how many years of substantial earnings do you have total? If you have less than 20 years of substantial earnings, you're going to be maximum windfall. If you have 21 years of substantial earnings, the math we use to do that equation changes. So instead of doing 40% times 1024, well, now we're going to do 45%. If you have 22 years, 50%, 23 years, 55%, all the way up to 30. If you have 30 years of substantial earnings, then you're not windfalled at all. You're considered a windfall elimination exclusion. You'd get a maximum benefit from us, you'd get your pension, and we'd all walk away very happy. What you can do to figure out where you fall within the windfall exception, if you think it's going to impact you, is go to our website, socialsecurity.gov, and review our windfall elimination provision calculator. A ways back, we talked about the retirement estimator calculator that we have. Now, that's not going to ever factor in your WEP. That's only ever going to give you your gross retirement benefit. If you wanted to see what impact windfall would have on you, you would check the windfall calculator, because that will factor in years of substantial earnings, and it'll give you an estimate of what your pension would be after the reduction. And it has the same functionality as a retirement estimator. It's going to let you pick and choose the dates. So again, if you wanted to know what your benefit with windfall would be at 62, it'll tell you. 65, it'll tell you. 66 and 6 months, it'll tell you. So for those of you impacted by windfall, I highly recommend this particular application, this particular calculator, to get an idea of what your actual benefit will look like. Very useful tool, fairly accurate, So another great resource that you can use. What we're going to talk about next is the government pension offset, which is kind of the evil twin sister of the windfall elimination provision. And let's be clear, let's get just so everyone's on the same page. Remember this: windfall impacts your ability to draw your benefit. Windfall does not affect your spouse. It is your ability to draw your benefit that the windfall impacts. Government pension offset impacts your ability to draw from a spouse who may be eligible for Social Security. Now, just like windfall, we only care about the government pension offset when you are trying to get that spousal benefit and your pension at the same time. If you are only drawing your Social Security spousal benefit, we do not apply the government pension offset. But the nanosecond you get your spousal benefit from us and your government pension, or your non-covered pension, pardon me, we care very much. You need to report it to us. Unlike windfall, which legislatively can never reduce a benefit to nothing, government pension offset can. And how government pension offset works is like this. You would come in, you would file for your spousal benefit. Remember, your spousal benefit is 1/2 the primary wage earner's benefit while the spouse is alive, 100% if the primary wage earner has passed away. We're going to look at the spousal benefit, and then we're going to ask to know what your non-covered pension amount gross value is per month. We then take that value, we take 2/3 of that value, of that non-covered pension, and we subtract it from the Social Security spousal benefit. So let's say you're eligible for a Social Security spousal benefit of $1,000, and 2/3 of your non-covered pension is $800. In that scenario there, you would walk away with a Social Security spousal benefit of $200. The difference between the spousal benefit minus 2/3 your non-covered pension. Let's change the scenario a little bit. Let's say 2/3 your non-covered pension is greater than your Social Security spousal benefit. Now, in that instance there, you do not get a Social Security spousal benefit because your 2/3 of your non-covered pension exceed the benefit we would offer you. The last thing I want to go over in this section are taxation of benefits. Just please keep in mind, this is a result of the 83 Amendments Act. Prior to 83, benefits were not taxed, but post 83, they are. And it all depends on what you report as your modified adjusted gross income. So for an individual filing a tax return between $25,000 and $34,000, up to 50% of their benefit could be taxed. If they're reporting more than $34,000, up to 85% of their benefit could be taxed. If you're filing a joint return between $32,000 and $44,000, up to 50% could be taxed. More than $44,000, up to 85% could be taxed. For questions regarding taxation of benefits, you would want to reach out to the IRS. We do and can have taxes taken out of your benefit, and if that's what you'd like to learn more about, you'd want to contact one of our local offices. Applying for benefits at this time, applying for benefits can be done online or over the phone, again, through our website, socialsecurity.gov, or by calling 1-800-772-1213 and scheduling an appointment. The last thing we're going to talk about today is Medicare. There are 4 parts to Medicare. Part A as in apple, B as in ball, C as in cat, and D as in dog. When talking about Social Security and Medicare, what you need to know is Social Security only assists with Medicare Part A, which is hospital insurance, and Part B, which is medical insurance. And when I say we assist, what we do are 3 things. We enroll an individual, we disenroll individuals for a whole slew of reasons. And lastly, if you're getting retirement or Social Security disability insurance, we take that Medicare Part B premium directly out of your benefit. And again, that is legislative. It's the law of the land. We're going to focus in on specifically Medicare Part B. Medicare Part A, the hospital insurance, if you are vested into Medicare, is free. There's no monthly premium to have it. Medicare Part B, there are premiums. There is a monthly premium. And that premium can kind of fluctuate depending on certain circumstances. There are 5 periods of time in which an individual can become eligible for Medicare. They are if a person has been exposed to an environmental health hazard, if they've been on Social Security disability insurance for greater than 24 months, they are age 65, they have ALS or Lou Gehrig's disease, or they're suffering from end-stage renal kidney failure. For the remainder of this presentation, what we're going to focus in on is individuals turning age 65, because this is the most common period of Medicare enrollment. So there are 3 periods of time someone 65 or older can enroll in Medicare. The most common is the initial enrollment period. This is a 7-month window built around your 65th birthday. It's 3 months before you turn 65, the month you turn 65, and 3 months after you turn 65. Now, if you enroll in this window, your Medicare Part B is going to start right around 65, and we'll break down those enrollment dates in a moment, but just know for now it's going to be right around 65, and you're going to start off for Part B paying that base premium, which is, like I said, for this year is about $170. Now, if you miss that window, you only have two other opportunities to enroll in Medicare. The next is the general enrollment period, which is actually going on right now. The general enrollment period runs annually, every year, January 1st through March 31st. Now, some important things to note about the general enrollment period. If an individual is older than 65 and they enroll during the general enrollment period, a couple things are going to happen. Now, their Part A is going to start right around the time they enroll. For this year, for 2022, their Part B would not start until July of this year. Additionally, the individual is going to be assessed a 10% penalty for every year they missed signing up for Medicare beyond their initial enrollment period. So if you have an individual who is 70 and they come in on February 2nd to apply for their Medicare Part B, they could enroll that day. They would get their Part A right around February. Their Part B would not start until July of that year, and they would be assessed a 50% penalty on top of whatever the base premium is. So for this year, it's $170, so 50% on top of that. And here's the thing, the penalty never goes away. It sticks with that premium for forever. The only way to avoid that post 65, post initial enrollment window, is if you meet the qualifications of the Medicare Part B special enrollment period. To meet the special enrollment period, we have to be able to prove two things are true. That from your 65th birthday to whenever it is you have come in and decided to apply for Medicare, that you have been actively employed, and that through that employment, you have received group health or large group health insurance. We can change that slightly. If your spouse is actively employed and you are receiving insurance through their employer, again, large group or group health coverage, you can also use that to defer post 65. So in the example we gave a moment ago, an individual comes in February 2nd, they are 70. They could say, I meet the requirements of the special enrollment. And as long as they can prove to us that from 65 to 70, they've had continuous work, active work, you have to go in, clock in every day, and that employer has provided them with health insurance, group health or large group, we would give them a special enrollment into Medicare, no penalty, and the Medicare Part B would start the month after the month they contacted us. So again, in this example, if they came in February, they'd get their Medicare in March. OBRA doesn't count. COBRA doesn't count. Purchasing your own private insurance doesn't count. Severance packages do not count. It must be active work seamlessly with insurance. If you do not meet that qualification, you're going to fall back into the general enrollment rules. Now, a moment ago, we talked about your initial enrollment and kind of the start dates for Part B. So during initial enrollment, the Medicare Part B start date depends on when in that 7-month window you enroll. So if you enroll in the 3 months before your 65th birthday, your Medicare Part B starts the month you turn 65. If you enroll in Medicare the month you turn 65, your Part B will start the next month. If you enroll 1 month after turning 65, your Part B will start 2 months later. If you enroll 2 to 3 months after age 65, your Medicare will start 3 months after your enrollment date. For Medicare Part B enrollment, I highly recommend, in advance of your initial enrollment window, contacting your local office, and you can get the number to your local office on our website, socialsecurity.gov, just by typing in your zip code in our office locator page. You'll get the phone number you can call, or by contacting, again, the 800 number, 800-772-1213. Either way, calling us and discussing when would be the best time to enroll to make sure that as you transition off your private insurance onto Medicare, we can try to get them to abut rather than overlap, so that you can go from 1 month on private into the next month on Medicare, and you don't have to pay double premiums. We can't always do that. Sometimes it just doesn't work out with the enrollment dates, but in advance of, if you give us some time to prep and look at it with you, we can usually help you in squaring that away. So I do recommend, again, reaching out to your office and having us assist you in just making sure you're picking the right entitlement date. Now, the last thing I want to touch upon on Medicare today, in 2003, under the Bush administration, the Medicare Modernization Bill was passed, law was passed, and this did a lot of great things for Medicare. Prior to the passage of this bill, there was no prescription drug plan with Medicare, and this bill brought prescription drugs to Medicare. One of the other things that it brought was the Medicare Part B surcharge. Well, I guess it should say Part B and D surcharge. And how the surcharges work is we look at your earnings, we look at your modified adjusted gross income as filed on your taxes from 2 years before. And depending on what you report in that particular column, you may have to pay a little bit more in Medicare Part B and D premiums. So if you're looking at this chart here, what you will see is that for an individual in 2022 with a modified adjusted gross income of about $91,000 or less, or a couple with a modified adjusted gross income of about $182,000 or less, pardon me, they would pay the $170.10 premium, period, and no additional surcharge on their Medicare Part D premium. Now, Medicare Part D premiums tend to fluctuate because they are administered by third parties. That's why we don't get involved in Medicare Part D. But whatever that would be, it wouldn't change. Now, if you had an individual with a modified adjusted gross income above $91,000 up to $114,000, or a couple, $176,000 up to $222,000, they would pay the base premium on their B of $170.10 plus an additional $68. And on their Part D plan, whatever that premium is, they would pay an additional $1,240. So the higher your modified adjusted gross income is, the more you're going to be expected to pay in Medicare Part B premiums. This is appealable. Remember, it's a 2-year look back, meaning if in the intervening year your income has gone down, it is possible we can recalculate this surcharge. There are 8 what are called life-changing events. They're things like loss of a job, loss of a spouse, loss of an income-generating property, loss of a pension, and a few more that if you qualify for and your modified adjusted gross income has gone down in the intervening year or the current year, we can use that new figure to calculate the benefit. If you think you're going to fall into that category, again, I'm going to recommend that you reach out to your local office or our 800 number and speak to one of our representatives. They'll determine if you meet one of the 8 life-changing events and then work with you to appeal the surcharge so we can reduce your Medicare Part B premium. At this time, I'd like to thank you very much for having me here today, and I hope you are all very well. Thank you.